Well, equities in India is something which, as a young country, when you're 24, 25 years average age, uh, I mean, it's just the
He
most
keeps talking
obvious
about
thing
age
you have
again
to
and
be doing.
again. I don't know why he's pointing towards me or he's pointing towards you, Tanvir. I don't know.
Well, think of it. The index we started in, 1980 as
Yeah,
100.
yeah.
And here we are, 35 years later, and it's closer to 30,000. You don't get that kind of wealth appreciation in any other asset class. So while our memories stick to the price of the flat we bought or
Yeah.
the piece of gold we bought,
Yeah.
the fact is equities have outperformed all these asset classes over any 5-year, 10-year period that you want to pick up. Because reality is that businesses make money and they're living organisms and they produce cash flow. Whereas a dumb asset which doesn't actually produce cash flows will probably never ever keep pace with that. And India being the last really big growth market in the world, because if you think of, all the OECD countries, we can
Yeah.
think of them as the governments are bankrupt, the central banks are bankrupt, the consumers are over-levered, so there is no growth. This is the last big country of 1 billion people with growth available to them. And if you're not participating in that growth, which is really possible only through equities, what are we really doing?
When you talk about growth and we look at quarterly earnings
Sure.
every 3 months,
Yeah.
how are you mapping the trend on that growth which will fuel equities further from here?
So,
Because it's not really coming
Yeah.
as per plan.
Yeah. So, well, there are 2-3 structural issues there, and you've got my sore spot, because in India we've had this thing of tendency of aping the West and following old economic theory. And I think the heart of the problem in India is that unless you get per capita income levels up, you will not get consumption up. And if you don't get consumption up, you will not revive the investment cycle. And just by way of example, I remember 1998 when we compared China and India,
Yeah.
we both sold about 1 million cars each.
Yeah.
Here we are 17 years later. China has gone from 1 million cars to 22 million cars. India is stuck at 2.6 million cars for the last 4 years. And you can just look at it very easily and say this is because per capita income has stagnated. Also, it's not just that the market size is 8x. The price point of the car, which in India is the average price is, let's say, a Maruti Alto. The average car in the world and in China is a Toyota Corolla.
Yeah.
So even the
that's true.
price point is
That's
probably 3 to 4x. So you have possibility of a 20x expansion in our markets, being held back because we want to keep depreciating our rupee. We follow this great interest and inflation differential argument, and I find it strange in a post-2007 world, when if the whole world has collapsed and gone into deflation, these guys will never get inflation, and they will constantly be fighting against recession by printing money. And ordinarily, if you print 20, 30 trillion dollars, your currency should have collapsed.
True.
But what's happened is our rupee has gone from 40 to close to 70. And we're going to keep depreciating, and yet our exports aren't going to pick up because you don't have the capacity and the productivity gains happening over here. So it's some structural changes are required. And you're right, that's what's holding back earnings over here, because you just aren't getting the demand.
But Manish, if I look at how this Samvat year has gone, we are openly using the word zero interest rates now.
Sure.
We've seen a strong recovery rally in emerging markets, especially commodity-based emerging markets, and you got big slowdown which is now visible in global sectors, at least Indian IT and pharma.
Sure.
So is the market leadership changing now? Is there something which we need to be watchful of? India was always gaining ground because of IT and pharma.
Sure.
That wheel now seems to be reversing.
Sure. So it's fair, and I just take you back very quickly to 1972 when we broke the gold standard and Bretton Woods came about and dollar became the peg. Ever since that, the US dollar has actually been printing without the world realizing the game which is going on. And that led to bubbles in every decade. So in the 70s, you got this bull market in gold, silver and oil, which culminated in the peak of 1980. Then they had a 20-year bear market in those asset classes. In the 1980s, it went to what was then emerging markets of Japan and Taiwan. And they were between 12x to 20x in that decade. Then, as you know, Japan has been suffering for the last 25 years. In the 1990s, we got the tail end of that through the Harshad Mehta scam, but promptly collapsed. But the 1990s then became the era of TMT, which culminated in the NASDAQ of 2000, 2001 peaking out. And the NASDAQ's only now started surpassing the previous high. So the 2000-2010 period was the era of commodities and BRICS. And much as I hate to say it, the fact is it is a bear market for commodities and emerging markets. What we are seeing are counter trend rallies in beaten down asset classes. So last year, I mean, Diwali to Diwali, Brazil, steel, these have been the best performing markets and sectors. But it's not like they are in bull markets. They are counter trend because they were so beaten down. And you're not getting a bull market there. Similarly, Indian IT, which in the 1990s was a sunrise sector, or our generic pharma, which was a sunrise sector, it's also facing its own disruption. So if you think of it in 2000, 2001, I think Infosys, I recall, was a 20-25 billion thereabouts, was the peak market cap. At which point, basically Apple really wasn't a mainstream company.
Yeah.
It was
wasn't
probably
there also.
under 15 billion. Well, Steve Jobs had just come back, but they hadn't yet made anything. Amazon was just a gleam in the eye, and Google wasn't yet born. Today, these three companies alone have a market cap of $1.5 trillion.
Which is more than our
Just
markets.
these three, which is more than our combined market cap. So there are changes in technology, and it's like how IBM has now got deflated.
Yeah.
And IBM is a $150 billion market cap. So also with Indian IT, that they have to reinvent themselves, and at least the leaders in TCS and Infosys are very much what I call in the mold of people who can remake their companies. The price points are interesting. So while there are structural issues, I think it's a bit like how metals and materials were last year. They're beaten down a bit too much, and you might well get a counter trend rally.
So
there,
next
just
year,
price-based.
if we come to Flames, we could be discussing outperformance in IT. Like right now, we're discussing outperformance
It's possible,
in metals.
because I don't think last Diwali anyone was taking a bet on steel and
Yes.
aluminium and Vedanta and
Yeah.
Hindalco and stuff like that.
But it's
They've been the best stocks.
No, it's interesting you say that metals are just, kind of adjusting to having come out of a really oversold
Right.
zone. So you're not buying into the commodities revival?
Well, the big counter rally is over. I think
Okay.
you've got the 100% gain. I don't think from here you're going to make 100% more.
Okay.
They're still great businesses. I mean, Nikunj and I were talking on the way here. In terms of profit pools, if I take the material sector, the big listed ones, there's a $18 billion profit after tax in that space.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.